Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at some high-frequency estimates of global GDP growth. We'll also do a deep dive into that non-farm payrolls number that came out on Friday. And finally, we'll have a look at business confidence in South Africa. We're going to start off with global GDP growth. The latest global PMI estimate has increased to 52.9. That's close to a three-year high. And that indicates that month-on-month GDP activity at a global level has recently been accelerating and is currently running at close to the fastest rate that we've seen in 3 years. Now, when we looked at this data last month, the key driver of that increase in global activity had been the US economy. And we noted that that was somewhat surprising at the time, and we've seen a slight reversal in that. The US PMI number came down, suggesting a slight cooling of that economy, and we'll get into more detail on that shortly. What drove the global increase this time around was emerging markets, China in particular. So we've seen this uptick in economic activity, but primarily due to emerging markets this time around. And we'll monitor this over the coming few months. The clearest evidence of an increase in economic activity out of China comes from commodity prices. We've seen copper recently been quite strong, up around 3% over the past month or so. Iron ore too, up quite strongly, up 2% over the past month, and in fact, up 9% over the past 6 months, up 15% over the last year. So we've seen a combination of industrial metals that are doing quite well, and that typically would be correlated with an improvement in economic activity out of China in particular. So there are a couple of data points, and we've mentioned some over the past couple of weeks, that do point to Chinese economic activity reaccelerating. It does seem to be a case that there's a broad set of views in the market, and of those views, there's still quite a large number that suggests that the Chinese economy is slowing. We don't see that at the moment. We're seeing a reacceleration, again, confirmed by higher commodity prices. And that should be good for commodity exporting emerging markets, as well as still very helpful for resource companies. While we're on PMIs, it is still worth looking at the manufacturing PMI data in the US. The series is still below 50, and typically it correlates quite strongly with employment. And that series is suggesting that employment is likely to still be weaker for a while yet. And this is one of the leading indicators that we've looked at for some time, which has suggested to us that the US labor market was going to slow. It took longer than we thought it would, but nonetheless, the US market has slowed, as we'll touch on shortly. And this data does suggest that we're likely to see a further slowing ahead. On to the non-farm payrolls numbers, which came out on Friday. It was pretty weak. Total non-farm payrolls increased by just a bit over 20,000 last month in the US. The consensus number was 75,000. So a miss. But in addition to that, the prior 2 months were revised down as well. And that means that total non-farm payrolls growth for June was actually negative. The initial estimate was that non-farm payrolls growth was over 140,000. So a big divergence between the latest numbers and the initial numbers. And as we had cautioned some time ago, we have to take the latest numbers with a pinch of salt because they may well too be subject to revision. So the latest data quite clearly suggests a slowdown in the labor market in the US, but that slowdown might be even greater than the latest data suggests. We just have to wait a couple of months for the latest numbers to settle. If you look at the 3-month average based on the latest numbers, that's sitting at just a bit below 30,000. You can see there's been a steep drop off, and quite clearly it's the case that the US labor market is slowing. If you look at year-on-year growth for total jobs in the US, that's currently running at just a bit below 1%. That's quite low for non-recessionary periods. And as a result of this number, I think we're likely to see increasing speculation that the US is drifting towards a recession. And we'll do more work on this over time, but we're likely to see the word recession come up quite a bit more in financial press over the coming few months or so. If we get into some of the details of the non-farm payrolls print, less than half of industries in the US added jobs last month. That's very unusual. Typically, that only occurs in a recessionary environment and just provides further evidence to believe that the R word is likely to come up quite a bit more over the coming few weeks. It's particularly tough at the low end. If you look at wage growth for restaurant workers as an example, it's now down to 2.9%. It still is a bit above inflation at 2.7%. But not very much above inflation. And we've got reason to expect that wage growth is likely to slow further For example, if you look at the quits rate, it's typically a leading indicator of wage growth, and that suggests that wage growth on an aggregate basis is likely to continue to decelerate over the coming year or so. In addition to all of this, where we see that the private sector is shedding jobs, manufacturing is shedding jobs, the US government is shedding jobs too. Total government employment in the US is down just over 80,000 over the past 12 months or so. You put all that together and the unemployment rate in the US ticked up. It's currently at 4.3%. That is still below the level that would trigger the SARM rule, which would indicate that the US has gone into a recession. So it's clearly not the case the US is in recession yet based on that rule. But nonetheless, there has been a shift in the employment situation. If we look at consensus forecast, the current consensus forecast of the non-farm payrolls growth is going to be below 100,000 jobs per month on an average, a quarterly basis, all the way out to the second quarter of next year. So the current consensus forecast is while the labour market is slowed, it's likely to remain weak for the foreseeable future. And I think that's something that we should be penciling in. The situation has shifted. We are now in a much weaker employment situation in the US. And we can see that because there are now more people unemployed in the US than there are jobs on offer. And that's the first time that's happened since 2021. And when that shift changes, typically leads to quite a rapid increase in the unemployment rate. So we do need to be aware of the fact that we could see a quite rapid increase in unemployment in the US for the next little while. And as part of that, job openings have declined. So you put that all together, and the market initially actually ramped on the news. The US market opened up about 0.5% or so on the basis that it's more likely that the Fed is going to cut. But that was quickly reversed as the market became aware of the fact that this indicates that the US economy is slowing. Now, at the moment, the market is pricing in 5 rate cuts from the Fed over the coming year, and for there to be 3 consecutive cuts starting in September. That's quite optimistic. And what that means, in effect, is a lot hinges on the next inflation print. And should it be the case that inflation surprises on the upside, we could expect a sell-off, or if there's any indication to suggest that the Fed is unlikely to cut by 5 times over the coming year, we could expect to see the market facing some pretty severe headwinds. So we've done a deep dive on the employment situation. As we see those next CPI prints, we'll do a deep dive then too and try balance the two and try to get an idea of what's likely for the Fed over the coming year. But at this point, we do think that the market is a bit optimistic with regards to the outlook for interest rates in the US. Switching to South Africa, business confidence declined again last quarter. We saw that last week. Business confidence is the key leading indicator for private sector job creation. So as things stand, we're likely to experience a weaker jobs market over the coming few months based on that data alone. Now, we do need to contrast that with the support for the SA economy coming from higher commodity prices. So we've got this combination of weaker business confidence, but higher commodities. And we'll see how that settles over the next little while. But just like in the US, it puts a lot of focus on the SARB. And should it be the case that we do see a set of rate cuts that will provide significant relief, and we see employment picking up, we see discretionary spend pick up, should it be the case that the SARB is unable to do so because they want inflation to get to 3% sooner rather than later, and we'll hear more from the SARB on this over the coming few meetings, then we're going to be in a situation where business confidence is weak, interest rates are high, and then that isn't probably fully offset by the improvements we're seeing from commodities. So a huge focus on the SARB over the next couple of meetings or so, and we will monitor the data coming out of those meetings very closely. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider and a registered credit provider.